Paul Nolte, Senior VP at Kingsview Wealth Management. Paul, happy Friday to you, pal. Good to have you on the show. What do you make of some of the strength in copper? What do you make in some of the hopes for the industrial economy?
Yeah, it's been really kind of interesting when you take a look at you step back and take a look at the earnings numbers for the quarter so far, as well as some of the economic data. It's very uneven. They've been coming in a little bit. The earnings have been hitting the mark for the most part. A little light on revenue. Certainly, the guidance going forward has been poor, and we're seeing still the industrial side coming down a little bit. So, the home builders I think are doing very well, given the fact that we've got low interest rates and a rate cut coming. And I think copper has picked up a little bit because housing is doing reasonably well at this point. And certainly, there's a lot of demand for it still. Yeah. So again, they're bouncing off of some low levels here. We'll see if it's anything more than just a knee-jerk reaction, but home building has been on fire all year.
EEM, an emerging market ETF, is up about 5% since its low here in October. I'm wondering, Paul, if you view emerging markets and kind of just non-U.S. markets as being part of the same maybe value cohort of investment opportunity that has been beating lately.
Yeah, and that's really been it. When you take a look at over the last decade, the S&P 500 has been king of the hill, and growth has been the better part of the S&P 500. That's not necessarily unraveling, but we're seeing a little bit more of a tug-of-war between growth and value, and certainly international and emerging markets as part of that. Valuations internationally are as cheap as they've been in a decade or two. Performance has been relatively flat in a dramatic way over the last year or so. So I think from a long-term perspective, I think you're good picking up some emerging markets and international here, but don't expect that you're going to get great outperformance immediately. But I think it's one that you can probably ride for 3 to 5 years as some of that plays out. As we get a little bit of a rotation, we think, from more growth to more value over the next 5-6 years or so.
What do you see as being the biggest determinant of that, Paul? Do we need to try and read the tea leaves on every China-U.S. meeting, or can we just watch the 10-year yield as the bellwether for if this sort of tide turns?
Yeah, it's kind of interesting because really I think it's more on the dollar than anything else. Most of the debt, especially in emerging market, is denominated in U.S. dollars. So the strengthening dollar hurts the emerging markets kind of in two ways. One, they have to repay the debt, and in a stronger dollar makes it that much more expensive for them. So we've seen the dollar flatten out, weaken here a little bit over the last couple of weeks. I think that's given a little bit of a bid to some of the emerging markets, certainly, as well as international. So I think really more the dollar than the 10-year is going to be the determinant here. If we look at the 10-year, we get a rate cut next week. That's certainly been in the bag, if you will. And I think we're hearing at least they may be done after that for a while and sit back and watch to see what happens to the economy. Again, if that happens, I think you can get some benefit, too, from the emerging market area.
We've seen a lot of early rallies in bonds and fades over the past 10 days, Paul. I mean, the chart of the ZN, the 10-year future, seems solidly within a downtrend, even as we've had a couple rough spots here for either geopolitical news, the delay of Brexit, or a couple sizable top-line earnings misses with Texas Instruments. It's like the bond momentum is lower. What do you think Powell is going to do for this market next week? If he says cut and then maybe hesitates on December, which seems like the playbook you're going by right now, what do you think that means for the 10-year bond?
I think we'll actually see the 10-year bond back up here a little bit. I think you'll get the yield curve steepening a little bit more. So I think the short rates come up a little bit more than the 10-year. When you look at the economic data, that's been really the driver for the 10-year at this point. Manufacturing has been weak. I think what you're going to wind up seeing is the market is going to read that as the economy is good enough to stand on its own. And that's why I think you'll see the backup in yields if they do step away. Historically, the markets, or at least certainly the last 10 years, the markets want lower rates now and as much as we can get now. So a step back would be almost tantamount to a raise in interest rates in the market's eyes. So I think we do see a 10-year that backs up if we do see Powell step back and say, you know, we're going to be done for the year. We're taking the rest of the year off.
Yeah. Now, to the last point here, to just point out the significance of this, which is 6 months ago, if Powell had not given a highly dovish message, many would argue that is bond bullish because it puts the economy in risk. But I guess the lesson here is over the last 30 days, with bonds generally drifting lower, maybe some of the market's concerns are ebbing about the risk of the economy eroding.
I think so, and certainly when you look at least the rhetoric, and we've been down this road, I don't know how many different times between U.S. and China, at least that's cooled a little bit. Brexit might actually get resolved or at least closer to a resolution over the next month or two than it's probably been in the last 2 years. Both of those, I think, are going to be good for global growth, certainly U.S. growth. So it makes sense at least to take your foot off of the brake here a little bit. And certainly if we talk about more rate cuts, then maybe we are talking more of a recession than we had as just an insurance rate cut that we got earlier this year. This would be number 4 if we get another one beyond October. So that tells me that the economy is in much worse shape than we all think, and that could spell more problems for the equity market than certainly the bond market.
All right. Nice conversation, Paul. Really good stuff. Have a great weekend, Mr. Nolte. Joining us from Kingsview Asset Management.